Welcome back as we continue to monitor uncertainty around tariffs, inflation, the labor market. How's the consumer holding up? Here to discuss is Mastercard Economic Institute's chief economist, Michelle Meyer, recently releasing a forecast for the holiday season, expecting retail sales to grow by 3.6%. Welcome. It's good to have you.
Thank you. Good to be here.
So how does that compare, 3.6%? What does it say about where we are in consumer spending?
It's a solid growth rate and actually pretty consistent with what we've been seeing throughout the summer. When we look at our high-frequency spending pulse data, we saw acceleration in spending into July and August, trending right around that mid-3% range. So it's pretty solid. I do think it will feel different than last year, though. When we look at holiday spend last year, we ended up with 4.1% holiday spend, really driven by volume. There was just a lot of movement of goods, in part because we had so much disinflation, or even deflation in a lot of those categories last year for holiday spend. This year is a little different. There's a lot more pricing. There are a lot more hurdles to work around as a consumer, but we think the consumer will be engaged.
Overall, what does inflation look like for goods that you track?
So, I mean, if we look at the latest CPI data, you are seeing some acceleration in apparel spending in a way that we hadn't seen in a while, particularly heading into the holiday season. Some incremental increase in electronics, appliances. Obviously, if you give the gift of furniture, there's been some price increases there. But it hasn't been alarming, and it hasn't been sudden. It's just trending in an upward direction versus this time last year where things were trending in a downward direction for those categories in terms of pricing.
Which is why the spending has held up despite
partly nominal.
Some of the pricing.
Are seasonal hiring trends concerning at this point in retail?
I mean, I think retail seasonal hiring is really hard to pick out because I think the pattern keeps changing year to year in terms of the timing of the holiday season and the type of workers you need. One thing that we've seen very clearly is this continued move towards e-commerce. So when we look at our own data, we're looking for 7.9% growth in e-commerce retail spend. That compares to just over 2% for in-store. So when you think about the staff you need and the talent you need to accommodate and succeed during the holiday season, I think it's changed.
Yeah, because people are online, going online to shop. There is also this idea that the high-end versus low-end consumer, and there's a big disparity there, and that the spending that you're seeing is being driven by the high-end. Do you break that down?
I think when you look at the forces of spend and what supports purchasing power, certainly the household balance sheet is a big part of that. And when you consider the wealth gains in the markets, when you consider the wealth gains in real estate, it's the upper income, higher end consumer that has access to that and is realizing that really positive and powerful wealth effect that they've had now for the last few years. So I do think that's a factor.
Owning assets is a game changer if you're a consumer.
Seeing the appreciation in assets, but you have to hold them in order to realize that appreciation.
Right. Are you at all unnerved by subprime auto financing, or got a Chapter 7 and a lender? I mean, that's beginning to get some notice.
Yeah, I mean, you have these things on the edges, but I think when you look at the overall story, take the New York Fed's delinquency data that's released quarterly. The percent of balances in serious delinquent have actually been trending ever so slightly lower over the last few quarters heading into this season. So I think overall household balance sheets are pretty well equipped to manage through this season quite well.
Well, on that front, do you worry about some of the signals we're getting in the job market?
So the job market is absolutely worth paying a lot of attention to, and not only total job creation, but the balance of the labor market. And while job creation has slowed, and we have to pay attention to that, particularly in terms of where the jobs are being created, it's concentrated in certain sectors. But it's also the balance of the labor market. And that's where I think we still are in pretty good balance when you look at the fact that, yes, hiring has slowed down, but we're also in a low firing environment. And it could be the case that the break-even jobs numbers are just a bit lower, and that's being reflected in the unemployment rate remaining pretty steady.
We did hear, though, from OpenAI's chief economist last couple of days that he did think the next 18 to 36 months is when, I think he used the term ravage, where AI will begin to ravage the job market. Do you think that's...
Well, that's more a structural change that the economy can undergo, and there's a lot of debate out there, rather than a cyclical dynamic in the economy. And that's really important to keep in mind as well when you're looking at the monthly jobs report, is how much is changing because the structure of the economy is changing, given this preference towards technological advancements and investment in capital, AI being primary, versus an indication of a cyclical change in the economy, I think that's really important to pull out.
And we just don't know yet.
And we don't know. But you have a sense by looking at a variety of different indicators, right? The fact that GDP is remaining strong, the fact that consumer spending is remaining robust. You have to look at it all.
Is this an economy that needs 2 more rate cuts this year?
I think it depends on where that break-even rate is. If the break-even rate, if R-star is around 3%, I think you can tolerate another 2 cuts because you can say monetary policy is a bit too tight with some of the cracks that are showing up. But to argue that the economy needs significant accommodation right now, no, I don't buy that. Yeah.